Stop everything right now because what just happened in silver is not normal. And if you own even a single ounce, if you're watching from the sidelines waiting for an entry, if you've been thinking about precious metals at all, the next 15 minutes could completely change how you understand this market. Today is Thursday, January 29th, 2026. Silver is trading near $119 per ounce. Let that sink in for a second. $119. Not a prediction, not a target someone dreamed up on a whiteboard. The actual price right now today. Silver has gained more than 60% since the start of this month alone. It's up roughly 275% over the past 12 months. This is the strongest monthly performance for silver since 1979, when the Hunt brothers tried to corner the entire market, and the whole thing eventually collapsed into chaos. And here's what scares me. Most people watching this rally have absolutely no idea what's actually driving it. They see the green candles, they see the headlines, they feel the FOMO crawling up their spine, but they don't understand the mechanics underneath. And that's dangerous because when you don't understand what's moving the price, you don't know when it's real and when it's about to reverse and take your face off. So in this video, I'm going to walk you through exactly what's happening in silver right now. Not the surface level stuff, the real structure. I'm going to show you why this time actually looks different from previous spikes, what the supply and demand numbers are telling us, what the major banks are projecting, and why one specific company is getting attention from analysts who think it's trading at a massive discount to what it's actually worth. And at the end, I'm going to give you the framework that separates people who make money in bull markets from people who give it all back on the way down. Stay with me because this matters. Quickly. I'm the voice behind Financial Crux, and I need your help with something. I want to build the most informed, most grounded community in the precious metals space. Not a hype factory, not an echo chamber, a place where real analysis meets real preparation. If that sounds like what you're looking for, subscribe right now and drop a comment so I know you're part of the crew. And if you want daily updates before they hit YouTube, join our WhatsApp community and follow us on X. The links are in the description. I post there first. You react faster. That's the edge. Now let's get into why this moment in silver is unlike anything we've seen in over 4 decades. The first thing you need to understand is that silver is no longer trading like gold's quiet little cousin. For years, that was the narrative. Gold moves, silver follows. Gold leads, silver amplifies. And there was truth to that. But something shifted. Silver is now being treated like a metal with its own fundamentals, its own supply constraints, its own demand drivers, and its own investment case. Gold just hit $5,500 an ounce. It's up 81% over the past year, and RBC is now talking about a stretch target near $7,100 if momentum continues. That's the backdrop. Hard assets are being repriced across the board because trust in paper is eroding. Deficits are persistent. Geopolitics are flaring, and investors are looking for things that can't be printed. But silver is doing something gold isn't. Silver is being consumed, not just hoarded. Consumed, destroyed, used up in ways that remove it from the market forever. Here's the part most people miss. According to the Silver Institute, total global demand for silver sits between 1.12 and 1.16 billion ounces annually. Current global mine production is somewhere around 813 to 835 million ounces. Do the math. Demand is exceeding supply by hundreds of millions of ounces every single year. And this isn't a new problem. The market has now recorded 7 consecutive years of supply shortfalls. 7 years. Not a blip. Not a temporary disruption. A structural deficit that keeps getting reinforced by rising industrial consumption. Solar panel production alone is expected to use between 120 and 125 million ounces of silver in 2026. Electric vehicle manufacturing adds another 70 to 75 million ounces on top of that. Then you layer in 5G infrastructure, medical devices, electronics, and everything else that requires silver's unique conductivity and antimicrobial properties. And you start to see why the squeeze isn't loosening. It's tightening. And here's the kicker. China just reclassified silver as a strategic material. New export licensing rules went into effect on January 1st of this year. That means one of the world's largest producers is now actively restricting how much silver leaves its borders. Think about what that does to global supply when demand is already outpacing production. This is not speculation. This is arithmetic. And the arithmetic says we have a problem that isn't going away anytime soon. Now, does that mean silver goes straight up from here? No, markets don't work that way. And anyone who tells you this is a guaranteed one-way ride is either lying to you or doesn't understand how volatility functions in a momentum market. When you see a move like this, 275% in a year, 60% in a month, you attract two types of capital. The first type is structural. Long-term buyers who understand the fundamentals and are accumulating physical metal or high-quality exposure because they believe the deficit story plays out over years. These buyers don't panic on red days. They don't chase green candles. They have a thesis and they execute it patiently. The second type is momentum. Fast money that chases performance. Algorithms that pile into trends. Retail traders who see headlines and feel like they're missing out. This capital is hot. It moves fast in both directions. And when it exits, it doesn't send a memo first. Right now, both types are in silver. And that creates a specific kind of market behavior. Big swings, violent reversals, and the kind of price action that makes confident people doubt themselves and makes cautious people suddenly chase. Veteran trader Peter Brandt recently pointed out that more than 1.5 billion ounces of silver have changed hands on exchanges. That's nearly 2 years of global production trading in a compressed window. The last time we saw turnover at this level was near the 2011 price peak, right before silver collapsed from near $50 to under $15. Does that mean we're at a top? Not necessarily. But it means you need to respect the volatility, you need to size your positions appropriately, and you need to have a plan for both directions, not just the one you want. When markets move this fast, the people who win aren't the ones who predict perfectly. They're the ones who prepare for multiple outcomes. The ones who say, if silver pushes higher, here's what I do. If silver pulls back 30% to shake out weak hands, here's what I do. You don't make those decisions in the moment because the moment is designed to trick you. Now let's talk about what the big institutions are actually saying because the range of opinions is telling. On one end, you have former JP Morgan strategist Marko Kolanovic warning that silver could fall by about 50% within a year. His argument centers on momentum-driven trading and speculative activity outpacing real demand changes. On the other end, you have Krupp raising its near-term price target to $150 per ounce. Their reasoning is straightforward. 7 years of supply deficits, record industrial consumption, and a market structure that still looks tight even at current levels. HSBC is somewhere in the middle. They acknowledge the rally, but caution that silver's rise has largely followed gold higher, and that momentum trading has intensified as prices accelerated. They don't view silver as a traditional safe haven, and warn that higher prices could eventually dampen industrial demand while encouraging recycling and new supply. So who's right? The honest answer is all of them might be partially right at different points in the cycle. Momentum can reverse violently. Supply constraints are real. Behavioral changes take time. The next move isn't written yet. And if you're looking for certainty, you're looking for the wrong thing. What you should be looking for is positioning. That makes sense across a range of outcomes. And that brings me to the part of this story most people will miss. If the silver deficit is structural, where do the ounces come from? Above-ground inventories are being drawn down, mine production isn't growing fast enough, and China is restricting exports. The only way to fill that gap long-term is new discoveries and new mines, and that takes years. That's why companies with real ounces in the ground become strategically important. This is where Silver 47 Exploration Corp enters the conversation. Continues with same structure through the end. Unchanged content, cleaned flow.